here's the big question. You're interested in value investing and valuing and evaluating businesses on a deep level, but you don't know how, even after researching for hours, probably dozens of hours, hundreds of hours on the internet, and because nobody else shows you how to do it. This podcast has all those answers and much more about value investing and finance. My name is Jason Rivera. Welcome to Value Investing in Your Car. Hey, Jason Rivera here. In this episode of Value Investing in Your Car, we are going to be doing something a little bit different. This is the final part in the three, if I could only rely on three investing metrics, what would I rely on? We've already talked about free cash flow to sales margin and ROIC. In this video, we're going to talk about the cash conversion cycle, and I'm going to take you through why this number is so important, and more importantly, what all it can show you, which is the more important part. This is one of the main reasons all of these metrics, ROIC, free cash flow to sales, and cash conversion cycle, are all metrics that show you multiple different things. There's nuances involved. They show you balance sheet strength. They show you how a company operates, capital allocation, all these different things. Cash conversion cycle, while we wait for this to load, shows you 5 to 10 different things, like both ROIC and free cash flow to sales can show you. So this is another reason why I rely on all these three metrics, is because they show you multiple different things. With just these three metrics, not only do you get the kind of base value of what the margins are and if they're good or not, but you also get the nuances again. Balance sheet strength, capital allocation. In this case, even more, you can tell with the cash conversion cycle, again, 5 to 10 different things, all of which I'm going to show you right now. After this reloads, it just loaded. Not sure why it's reloading again, but okay, so Morningstar, go to key ratios tab, go to efficiency ratios tab, cash conversion cycle. Oops. This is in days right here. Sorry, I'm having some issues with my Morningstar, showing some different issues. So what I like to look for here, actually, let me step back. What this is made up of, the cash conversion cycle essentially measures the cycle it takes a company to turn its cash into inventory, its inventory into sales, and its sales into more cash. That's why it's called the cash conversion cycle, because it's literally a cycle. This is ultra important for companies like the one we're looking at right now, which is a manufacturer. It's ultra important for retailers, ultra important for companies like Amazon that sell stuff, hard physical products. This metric is ultra important for companies that sell, any company that sells hard physical products. It's not very important for companies like insurance companies, internet-based companies, software companies, any of these kind of companies. It's typically not really important at all. But for companies that produce hard assets and either sell or produce hard assets, this number is ultra important. So here, days sales outstanding, number of days it takes for the company on average to get a sale of their product, days inventory, the amount of days the company has in inventory, and the payables period, how long they take to pay their suppliers for that inventory. Sorry, some rain just picked up. I'm outside my lanai right now, so hopefully it doesn't thunder and hopefully you can hear me still. So these numbers right here calculated together to make this number, which is the full cash conversion cycle. It takes on average in the trailing 12-month period 65.2 days for the entire cycle to complete itself. So what does that mean? Means it takes 65.2 days on average for, again, the company to turn sales or cash into inventory into sales, and sales into more cash. So the lower, because cash flow is king when it comes to businesses and evaluating businesses, you want to see this number lower the better. This number can actually be negative. If it is somebody like Amazon or Walmart, what does that mean when it's negative? Essentially, that means if it's negative, that the company is getting paid faster than it has to pay its suppliers for the products it's selling, which means it's essentially just printing money, because it's able to produce, it's able to sell at such volume. Again, typically you only see this Amazon, Walmart are the two off the top of my head where I've seen it, where you see a negative cash conversion cycle. Again, that is fantastic if it has a negative cash conversion cycle, but in general, what I look for here, this number, the lower the better, and you typically always want to see the trend. I go back 5 years, 52.9, 53 days in 2013, 65 days in the trailing 12-month period. So it has risen. What is that? About 13. I don't have my calculator right next to me. What is that? 20% or so. So that's not insignificant. It's not a horrible deal, because I can tell you right now, the industry affects this number greatly too. This company produces specialized parts for medium and heavy trucking and the boating industry. So, I mean, these aren't stuff like packets of gum like you get at Walmart or that will sell ultra fast. So the industry affects this number too. But again, the most important number here is the trend. If you see this going up, you need to figure out why. You pretty much always want to see this number going down, because if that means the company is becoming more efficient, which means it's producing more cash flow, which means its margins are going to rise. The opposite is also true in this case. Oh, big rain gusts or a rain squall here. Sorry about that if you can't hear me, or if you couldn't hear that part. What I was transitioning to, the opposite is also true. So if you see this number rising, which it has over the last 5 years, I will guarantee you their margins are lower. They have more stock in their inventory. It's taking them longer to do their sales, which most of their rise looks like it's due to this, which the sales outstanding mean are having more problem selling their products, which again, they are in a specialized industry, so that's somewhat to be expected. So what does that number... Oh, and here's to prove out the point about the margins being lower. Margins lower over the last 5 years, lower, and about halved actually, here at the operating margin level. Cash flow, same thing, because their cash conversion cycle has risen. Their margins have gotten worse pretty much across the board. What's ROIC? Across the board, the margins have got worse. So what this also means, because again, the industry affects it. This is a cyclical industry, so they're in a downturn right now. So that's why it's taking longer for them to sell their products, which again is leading to these lower margins and the higher cash conversion cycle. So those are some of the things this tells you, this one number tells you about. So it also tells you about balance sheet strength and inventory and AR as well. So let's go to the balance sheet. Oops. Go to thousands because this company is so tiny. Let's go to years. Let's back out to the years. So what we're looking for here is inventory, or AR and inventory. These should about rise and fall at about the same pace. If one's rising, the other should rise about the same amount. If one's falling, the other should fall about the same amount. So if there's not, the company is not being as efficient as it could be, which again leads to rising margins, which is proved out by the numbers rising. So what happened here is the company looks like they had too much in accounts receivable in 2013, 2014, 2015. inventory or AR rose a lot, about 14 million over the 3-year period here, while inventory is only raised by about 3 million. So they're not in equilibrium here, which leads to these falls in numbers here, these falls in numbers here compared to 2 years ago. Again, they're in a cyclical downturn, so that's part of it. Part of the reason what's going on. But again, this all leads to lower margins, lower efficiency, not as great capital allocation, all these kind of things. But that's still not all this number shows you. And I was hoping it would show it here. Where is it? Actually, we can see it here. So go back to the key ratios tab and look here. So as a percentage of the balance sheet, not very much in equilibrium here, 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 which leads again to which shows the fall here as a percentage of the balance sheet, and then there's a rise here again. So it looks like they're maybe getting more orders here again. What I was hoping to find was a case study where you can literally, with the cash conversion cycle, figure out if the company's, let's say, their cash conversion cycle has doubled in the last 5 years. That would immediately show problems here and here, or more drastic problems here and here, but also on the balance sheet. If they are having major cash conversion cycle problems, and you can again tell that like that just by looking at the number. If it's risen, let's say again in this example, it's doubled in the last 5 years. They're either having more problems selling their products, which means they may have to discount their products, which means they may have to write off completely their products, which would lead to this going down. They may have to do some kind of joint venture to get rid of their products at a discount. They may have to discontinue product lines. They may have to do all sorts of things to get their inventory and receivables back into what is selling. Which again, balance sheet strength. As a deep value investor, what we look for first is balance sheet strength. If the company has to write off because they're having cash conversion cycle issues, having issues selling their products, they may have to write off some of these, or more likely inventory, which would lead to decreased balance sheet strength, decreased balance sheet value, and decreased intrinsic value for the entire company if you value their balance sheet, which, as again, most deep value investors do. The balance sheet is where most of us start first. So again, this is why this number is so important. These 5 to 10 things I just named off for you are still only part of it. I can't really illustrate it here, and I don't have a company off the top of my head where the cash conversion cycle is just nuts, and you can automatically tell just by looking at the number that they're going to have to write down inventories at some point, because you will come across that in some occasions. I think the last company I evaluated in the real retailer market was it Bed Bath & Beyond for Tomaz P in a different video. I think I talked about inventories and cash conversion cycle quite a bit, because they will likely have to write down a significant amount of their inventories, which will lead to decreased value, decreased book value, decreased balance sheet strength, and decreased intrinsic value. So if you rely on price to book, which is here, at all, they're selling at a price to book of about 1 right now, which means they're about fairly valued, at least in terms of their book value. So let's say they had to write off all of this. Let's say they were having major issues, they had to write off all this. That would destroy $13.5 million worth of value here, here, and here. So, I mean, obviously that's a big deal, especially when you're looking at smaller companies or even bigger companies. If you're looking at retailers, Bed Bath & Beyond, Walmart, Amazon, not Amazon in particular, because a lot of their kind of third-party sellers have a lot of the inventory there. But Walmart, Bed Bath and Beyond, if they have to write off their inventory is probably their biggest expense, maybe outside of their employees. I would guess inventory is probably their biggest expense, unless they lease their properties. That might be up there too. But so this is an ultra important number. Again, by taking, and almost nobody talks about this number too, which will give you a massive advantage over other investors. Almost zero people talk about this number in the investment or value investment arena. And again, just look at the trend, see what it's here and here, see the trend, and you can automatically tell. That's how I automatically, as soon as I saw the trend going up, I knew the margins were down for the company and they were likely having some issues with inventory and AR. I have owned this company for years, so I'm very familiar with this company and the industry and the cyclical nature of the industry that's in, but I haven't evaluated this company recently. So I didn't know coming into this, before this video, that this was going to be the issue. Again, see this number here compared to here. If this is higher, which it is, margins are going to be lower across the board. May have some balance sheet issues. May have some issues selling their products, which could lead to some of the other issues we talked about. If this number is lower, let's say these were reversed, and this was the most recent number, margins would be rising, efficiency would be rising, cash flow would be rising, balance sheet strength would be rising, pretty much everything would be rising. So again, just knowing what these numbers mean and all the different nuances. And later this week, I think we're going to release another cash conversion cycle training video on Friday. And I've done several trainings on this. That's how important this is. I think at this point, this is the 5th training video I've done on cash conversion cycle and why it's so important. So I'll make sure to link those below if you're watching on the blog. If you're watching on YouTube, I will try to remember to link the playlist of the cash conversion cycle specific videos below in the comments. But some of these videos if I remember correctly, are specifically where I'm talking with some of my $10,000 coaching clients or masterclass students. So I think some of those videos are locked away, but I'll have me and my team will find some, and we'll definitely share some of them with you for free. If you're watching this on YouTube, make sure to like, share, subscribe, and hit the notification button. So you're notified anytime we release a new video, which we're making new videos pretty much every day. So make sure to hit the notification bell. If you're watching this on YouTube or the blog, there should be links to our other playlists. We talk specifically in this Value Investing in Your Car episode series. We talk about this is the final topic in the pretty much the 3 most important value investing metrics. If I could only rely on 3 value investing metrics, what would I be? This is the final of that series. I talk about the 4 most useless investing metrics. I give book reviews. I talk about when value investing works, when it doesn't, in this series. We got case study series. We got free training videos. We've got all sorts of training videos, specifically case study videos. Right now we're going through a company as of this recording, we're going through a company's financials in Australia that looks like a great potential investment right now at this early stage that we're in. So make sure to check out all of our other playlists. We got value investing education playlist, book review playlist. We got all sorts of playlists. Make sure to check all those out. And I hope you enjoyed this video and this last and final part of the if I could only rely on 3 investing metrics, what would they be? I hope you learned a ton from this kind of mini series within the bigger, larger value investing in your car episode series, and also from the most useless investing metric series as well. People learned a ton specifically from these 7 videos. I think this will be in these kind of mini series within the larger value investing in your car series. If you have any questions, comments, concerns about cash conversion cycle, let me know in the comments below, and I would love to answer them for you. Again, I love talking about this, and frankly, I've never seen another investor really talk about the cash conversion cycle at all. So if you have any questions about this, it's ultra important. And obviously it's ultra important, especially not only because all the stuff I talked about, but it's in this mini series where if I can only rely on 3 metrics, investing metrics, what would they be? So obviously it's important, but again, very few people talk about it, so you can gain a huge advantage over other investors just by looking at this one number. And I look at on a preliminary basis, so it can save you a ton of time by not researching crap companies, can save you a ton of time, get you away from crap companies faster, also help you, which will also help you find great companies or great potential investments faster as well. So that's another reason why I put on my value investment kind of preliminary analysis checklist, I guess, every time I research a company, because it helps save me a ton of time like the other metrics do as well. So I hope you enjoyed this video, and I will see you soon. Thanks. Have a good day.